Hello and good morning. This is Brent Bruce. I wanted to make sure to get out a new email video to you to update you on some big changes that came out on the 30th from Fannie Mae. This is one of the largest announcements I've seen in quite a while. Many of the changes that took place during the recession and the meltdown that were enacted by Fannie Mae are actually being rescinded. Some changes are being made and really loosening up guidelines quite a bit. So I just wanted to make sure to talk to you about three of those items that came out in Selling Guide Announcement SEL 2015-07. The first is the principal residence requirements for using rental income. In the past, you may require that we had to have at least 30% equity in a principal residence that was being vacated if we wanted to use that property as a rental. So I live in a house, I want to move out of it, and I want to use it as a rental. Well, I couldn't use that rental income to help me qualify for the new home unless I had 30% equity. That is gone. They have rescinded that requirement, so we are now able to use a vacated principal residence. We're able to use rent on that residence immediately. Now, as always, there's still different guidelines that apply, but that was the big sticking point with a lot of people trying to move up into a different property and retain the property that they were living in. So that has changed and has gone away effective June 30th. Also want to make sure that you're aware of bonds, mutual funds, 401ks, those kind of document assets. In the past, what we had to do was if someone had a 401k plan, let's say they had $100,000 in a 401k, we couldn't use $100,000 as an asset. We had to reduce that by 30%. We had to use 70% of that asset because they were considering taxes and penalties and things like that for that type of a plan. They are now allowing us to use 100% of that asset for reserves and things like that in their qualification. Now, if they're using that specific money for their down payment and closing costs, we're going to reduce it by 20% unless they're actually able to show the liquidation. So if they had a $100,000 401k plan and they liquidate it and they show us that they physically now have $100,000, of course we'll use that. In the past, we were having to reduce it by 30%, and in government programs we were having to reduce it by 40%. So again, loosening up the guidelines, something that's going to help us qualify clients. Now, the last one is the biggest one. I believe that anybody listening to this video who has been in the business for very long has been stuck by this rule, and it's what's called 2106 unreimbursed business expenses. This is the one that you would hear someone say, well, they're qualified, they're pre-approved, and then halfway through the process, ooh, they had some unreimbursed business expenses on their tax returns that we didn't qualify for, and now they don't qualify. Then we have to cancel the transaction. Now, first of all, the loan officer should have looked at that right away. They should always be looking for 2106 unreimbursed business expenses when they're qualifying a client. That's something that they should be doing in the beginning. Now, we just have been announced again, June 30th, that we are no longer going to have to hit clients for 2106 business expenses. That's a huge deal. I have had to reduce clients' income by over $1,000 a month at times. So this is really going to open up for some qualifying for clients that didn't qualify at one point. Now they might. So this is a good opportunity to go back and maybe talk to some people who we had to say, oh, we can't get you that $400,000 you were looking for. We can only get you $300,000 because of your unreimbursed business expenses. Things are going to change, especially for police officers, corrections officers, a lot of contractors. Those kind of people tend to have quite a bit of unreimbursed business expenses that used to really hurt them for qualification. Now, again, a couple of disclaimers with this. There are still rules that apply. People that are highly commissioned are still going to have to consider unreimbursed business expenses into their liabilities. Things like that we have to pay attention to. It's not just a blanket comment, but this is a big help and something that's really going to help qualification. So, as always, this is an announcement from Fannie Mae. That does not mean the bank that you're dealing with is going to have the same underwriting guidelines. They may have overlays. They may say, well, we don't care what Fannie Mae says. We still want to see 2106 unreimbursed business expenses reduced from income. They can say that. Overlays are allowed. But somebody who is a direct lender who is following the Fannie Mae guidelines, they should be able now to waive unreimbursed business expenses on most W-2 clients. Keep this all in mind. Obviously, this is something that is for the loan officer to worry about, but I wanted to make sure you knew about these changes because, again, this is one of the biggest changes and biggest opening of guidelines we've had in a number of years. If you have any questions, please give me an email or give me a call. I'd be happy to explain more. I'm going to go ahead and try to also get an attachment with the actual guidelines from Fannie Mae for you to review. May be a different language to you, but you may pull some information out of it. As always, I'll try to keep you informed. Let me know if you have any questions. Have a great day.